Good afternoon, everybody. We're going to get started in a second. Welcome. My name is Art Tintori. I'm the Managing Director of Financial Services for Catalyst Connection, and we're welcoming you to the first of our webinar series on strategic ownership. This is session 1. Today we're going to be discussing should I keep or sell my business. Once again, this is our first in our series. Catalyst Connection provides financial services. We provide a lot of assistance to companies accessing capital, and we really think it's a good opportunity to introduce a lot of companies to these services and strategic issues that are out there. So I'm going to present our speakers today. Our partner is Rivers Edge Alliance Group, and the speakers today are going to be Bill Powers and Cliff Brown. So right now I'd like to introduce you to Bill Powers.
All right, thank you very much. My name is Bill Powers. I work with Rivers Edge Alliance Group. Before we get started, I want to thank Art, I want to thank Allison and all the folks at Catalyst Connection for having us in today for what we think is the first of many important topics over the next month or so. The first one we're going to do today is, should I keep or sell my business? Facing the toughest question you will ever have to answer. That is going to be our discussion today, and you're probably going to say right now, okay, who's Rivers Edge Alliance Group? So I'm going to give you a little background on us. Okay, I'm going to go through the agenda first. Okay, sorry about that. The first thing I'm going to do, I'm going to give you an intro about what we do, why we're telling you this, and the expertise in the markets that we do. We're also going to go through important stats and trends. Everybody wants to hear stats. Sometimes when you see stats, it makes you think a little differently. Trends, same thing. What are the trends in the marketplace now? What are we projecting to be later? The big question for all you guys today is going to be, do I have a reason to keep my business now as it is? Or is there a reason to sell my business based on some information you hear today? If you choose either one of those options, we're going to give you the route how to achieve that option. We're going to give you tools that you can use to either facilitate a sale or to just sit and increase the value of your business over time. In order to do that, you're going to have to do a business assessment. You're going to have to do a financial assessment. Hardest one of all, you're going to have to do a personal assessment, because this has been your baby for how many years, and it's going to be hard to look at this with a unbiased eye. That's really, really important. We're going to recap all the ideas at the end. So, introduction. Art introduced me. I'm Bill Powers. I'm going to introduce Rivers Edge Alliance Group to you. What we are, the official term is we're a lower middle market investment bank. What's that mean? We work and involved with mergers and acquisitions. We give business valuations to people who are looking to see what the current present-day value of their company is. And we also do strategic ownership planning. How do you get your business from point A to point B in order to, make that decision on buy or selling? Normally, we deal with companies up to about $50 million in revenue. Up to $50 million in revenue. That's key to remember that number. And then, like I said, I'm Bill Powers. I'm the Director of Business Development. And in a few minutes here, I'm going to turn you over to Cliff Brown, who is our Director of Valuation and Strategic Planning. The next slide we're going to go to right now are the stats and trends I spoke about earlier. Okay? These are the numbers that are going to make you either happy or kind of scared where you're sitting right now. So the first one we have, the harsh realities of business transitions. 1 out of 2 business owners will actually face an unplanned exit due to the dismal D. One more time. 1 out of every 2 will face this unexplained event to exit their business. The deadly Ds. You look at death, disability, divorce, dissent, dissatisfaction. Just to make it clear that we're not going to, after you're done, try and sell you some life insurance or give you some sort of life insurance, let you know that the majority of these events occur not because of death or disability. They're the other Ds. Most people think it's the first 2. It's not. It's the last 3 or 4. So that's something really important to keep in mind. Okay, the first sobering stat I'm going to throw to you, 70% of all businesses are expected to change hands in the next 10 to 15 years. Okay? Right now, you're probably running numbers through your head. Where am I going to be, age-wise in 10 to 15 years? Where am I going to be financially at that time? That's all good to know, but the thing you realize, in the next 10 to 15 years, a lot of the baby boomer generation are going to be looking to sell or exit their businesses. And we all know the rule of supply and demand. okay? As they're getting older and looking to exit their businesses, the supply of businesses will go up. And unless your business is the most attractive one out there, it's going to be hard to get the price you're looking for. And I think today we're going to give you the tools to make you the prettiest girl to dance in the next 10 to 15 years. And that's kind of what our objective is today. Another sobering stat for you. 88% of business owners believe that their family will continue to control the business, but the survival rates are tragic. It's a tough word, tragic, okay? But here's what we're thinking about. I know so many people out there start a business, and as that business is growing, they eventually want their son or daughter to take over for them when they retire. Bring them in after college, let them learn the business, and move on. But 30% of these businesses, small number, small fraction, make it to the second generation. And that's a sobering thought when you think of you're going to build this and you're going to hand it over to your son, daughter, and it's going to be a smooth transition. If you're not prepared and you don't have the right tools in place, it is not going to be smooth. 12% make it to third generation. I mean, how cool would that be to have your business passed down to your son or daughter and then passed on one step further to your grandson or granddaughter? I mean, that's an awesome feeling, a pretty exciting thing, but it doesn't happen very often, 12% of the time. And the reason for that 12%, lack of planning. The last one, 3% make it to the fourth generation. I guess that's your great-grandkids. I don't know if I'll be around to see them, but I'm sure it'd be cool to leave that legacy of both pride, success, and financial stability all the way down to that fourth generation. It would make you feel a whole lot better if you had that plan and those tools in place. The last number we're going to look at, I'm kind of glad that accident just occurred there, because 83% of business owners have no comprehensive transition plan. Just like right there, we had something we didn't see coming because we think, okay, yeah, piece of cake is going to work, we have time. Wrong. Same thing with business owners. If you get that transition plan in place 10 years before you need it, your business will be so much easier to either sell when you want or hand it on to somebody else in your family. It's all about tools and preparation. And right now, I'm going to turn that over to Cliff, and he's going to give you some really good examples on how to get those tools in the positions in place to move your business forward. So, Cliff, take her away, my man.
Thank you very much, Bill, and good afternoon, everyone. I am very excited to be able to spend a little bit of time here during your lunch hour and share with you some issues that are very near and dear to my heart. I began working exclusively with family business owners about 26 years ago who were debating primarily whether to keep or sell their business. And even back then, the issues were emotional as well as financial. Business transitions are always complex, regardless of the size of the company, and they can literally bring out the best and the worst in people. And a transition becomes a focal point where power and authority, the business value, legal and tax issues, family dynamics, and trust or lack of it all come together at a single point in time. So over the years, I've worked in a wide variety of situations regarding succession. The healthy families who want to build or continue a legacy, the dysfunctional families who play out their problems inside the family business, entrepreneurs with giant ideas and caretakers who are reluctant to take risks, and finally those who resist letting go in spite of overwhelming evidence that they really should. And then there are the success stories of those who went on to coach success stories to greatness. And for those who have sold their companies, some are happy in their new activities and have started new businesses, and quite honestly, there are quite a few who are ambivalent and still second-guessing their decision to sell. So for some, selling the business is the right way to go. When the company has no energy or capital or growth on the horizon, owners are burned out and financially dependent on the business, and there are no successors, quite honestly, the decision to sell is easy. It's really the timing that's difficult in those scenarios. Alternatively, I've seen too many family businesses fail because the succeeding generation was simply not up to the task and were not adequately prepared to take over. And for them, this could have been avoided with a comprehensive plan in place. And as I'm sure you're aware, there are a lot of books out there about how to buy a company, and plenty of advice about how to sell your company, probably more so. But as I worked with clients over the years on the various issues we'll talk about today, I realized that there weren't many books or advisors out there that took a balanced approach to help a business owner decide what kind of decision they needed to make. And that's what we're doing here. I call this approach the keep or sell decision, and the choice is entirely yours. The key is knowing how to ask yourself the right questions to ensure that your decision is a successful one. And most importantly, the keep or sell decision should be something that you review continually as your business and your personal situation evolves. Once you've made your keep or sell decision, you're going to want to formulate an ownership plan and strategy. That's what Bill has been talking about. That provides the direction, the roadmap, the blueprint, if you will, for everyone that everyone is going to need in order to follow and to achieve the desired results. So let's start off with some reasons as to why you might want to sell your business. And keep in mind, just because I say keep your business, I don't necessarily mean that you're actively running your business until you die. Rather, it means that you and or your family maintain control over the asset that is your business. And here are some of the main reasons I hear from business owners who have decided to keep their business. First of all, there are trusting relationships. Business owners enjoy the long-term relationships that they have with their partners, their key executives, loyal employees, relationships with their community. These are very important, and they can be very meaningful in a person's life, and they are most definitely a reason to want to stay in the business. Secondly, keeping the business means that everything can remain private. You have a private business. You don't have to release or share information with anyone except your creditors and other folks who have a specific need. There's not a lot of information out there about you, despite what Hoovers would like to accomplish in their business plan. It's something that you're able to keep close to the cuff. And for a lot of folks, that is important, especially in smaller towns and in areas where everyone knows your business and you. It's nice to know that things can be kept confidential. Next, there's a pride of ownership and building a family legacy. That is the ultimate goal of multi-generational family businesses. The key there, however, is making sure that your successors have cultivated interdependent and supportive relationships, and most importantly, that they embrace your vision and plan as time moves forward. Next, long-term perspective. This is interesting because over the last 10 to 15 years, I've seen a number of businesses actually move or shift into generational planning tools such as trusts, which changes the focus of a business from an ownership standpoint. Whereas long-term decision-making in a day-to-day business may be 3 to 6 months out, when a business is multi-generational, you're talking about 5 to 10 to 20 years of long-term vision. That actually can create a conflict within the business, if you think about it, because there will be a conflict between the needs of the business on a day-to-day and shorter-term basis, contrasted with the needs and desires of a family looking for income and stability over 20 years. Next, as you know very well, you're able to control your compensation and your perks. You can employ family members. A lot of businesses appropriately employ family members who are experienced and educated in their particular roles, and there are also employees that really just do nothing more than show up on a daily basis, or not even that. And all of that is within the realm of what happens within a family business that's privately held. And it's certainly up to the business owner to determine what that looks like. Next, you're able to keep the family wealth consolidated in a single entity for multiple generations. There are, believe it or not, very good success stories out there. I have worked for one family business that is in now its 5th generation. They have done things right. They have a family legacy plan in place, and every generation coming in knows exactly what they are going to have to do in order to become a part of that family business. But they are now in the 5th generation. It's an amazing success story. Next, keeping the business To yourself means that you're able to have rapid decision-making. There are no committees, no bureaucracy happening. And lastly, wealth building. Certainly, that's what we all aspire to, of keeping the business versus selling, in that the business value, it should grow over time faster than any other asset that you have. Of course, you're taking on the risk in order to achieve that high level of growth as well. Okay, so just as there are good reasons to keep the business, there are some equally good reasons why you would want to sell. I'm going to go through these fairly quickly because I want to be cognizant of our time that we have today. First of all, there are opportunities with qualified buyers that come along. They have a fuse on them that gets lit, and you need to be paying attention to an opportunity that may come your way that seems too good to pass up. If it is, you need to evaluate that immediately, because there may not be another one that comes along. Secondly, and I see this a lot, there is a waning personal interest in the business. You've been in that business 20, 30 years perhaps, and it's just not exciting you like it used to. You come in every day, you feel like the business is holding you down, and you're ready to move on and do something else. Next, it might be a strategic decision. There are a lot of different things happening in corporate America today, competitive pressures, consolidation in particular in industries, foreign competition, various things that you're able to see in your business that might be appearing on the horizon that tell you now might be the best time ever to make a move to sell your business. Next, we can't ignore the fact that capital gains taxes right now are at historically low rates. They are as good as they have ever been for the most part. That can factor into your decision in terms of evaluating the net number that you might receive versus something under a higher tax structure environment. Next, partnership disagreements. If you have a partner, chances are the two of you have butted heads at one time in the past, maybe in the present, and those can escalate to the point where it becomes an untenable issue that one of the two partners has to go. And unfortunately, in a lot of situations like that, businesses end up collapsing and liquidating as opposed to transitioning from one or two partners down to one. There are some financial reasons. If you're looking at retirement and 95% of your net worth is tied up in your business, you might be wanting to think about diversifying your net worth, looking at retirement from an income standpoint, and reducing that risk that we talked about a minute ago that you take on every day in running a private business. Next, there might be some health issues that are starting to surface. Can't ignore those, and certainly the need to begin thinking about a transition, and in particular selling the business, happens a lot of times as a result of a health issue or a disability issue that arises along the way. Lastly, there may be no successors, or you're unsure of your successor's competencies and leadership skills. 50 years ago, it was assumed that children would take over the family business. Today, not so much. Children make their own choices, and even if the family business has been around for a long time, you can't necessarily count on the fact that they are going to want to join your business and participate in what you have built. And so if there aren't any successors, or worst case scenario where there isn't a competency level that allows someone to take over the business, selling might be the right choice. All right. So which route, which option makes the most sense for you? Well, while there are more than 7 paths that you can take, they really fall under 2 categories for most business owners, and that is keep or sell. Fundamentally, most business owners would not consider liquidation as an option, although that does sometimes happen. And going public with an IPO is not usually feasible either. So for today, we're talking about keeping or selling your business. Now, I'm not going to get into the specifics of each of your options, but keep an open mind as you think about the ideas presented here, because there are mechanical strategies that make any of them smoother and easier than you may think. And one of these options may be the best for you, and you haven't even thought about it as a possibility before. So within the keep structure, there are 2 options. The first I call the owner-manager model. That's probably what you're doing right now, where you actively run the business. day to day. The business was created by you. You are the business. Second option is the owner-investor model, wherein you hire non-family professional managers to run the business, and basically you are a passive owner of the business. And that has become more popular in recent years. We'll get more into that further into the presentation today, but there is some attractiveness to that for some very specific reasons. Next, under the sell, of course, we have selling to a third party. There are financial buyers and strategic buyers out there that might be interested in your business, but your management team might also be interested in buying the business, as well as your employees through an employee stock ownership plan. Those plans and ESOP plans have become very popular in the last 10 years due to a convergence of some tax improvements, but also because of what they are able to accomplish. And believe it or not, most business owners are surprised to learn that selling to their employees is not as clear-cut as it might seem in terms of who's actually running the business once that occurs. I'll ask it again, which route is best for you? And it keeps coming back to the same thing. The decision hinges on your assessment of the company, its operations, and your goals. So many business owners I meet with have an idea of what they plan to do with their business. But the issue is that they really haven't done any kind of critical assessment to determine if they, their family, and their business are up to the task. And many times they have not communicated their ideas to anyone else. From the business's standpoint, you need to think about the state of your business, not only today, but into the future as well. For example, if the writing is on the proverbial wall that industry consolidation is going to obsolete you in 10 years, then imagining a multi-generational business is just probably not going to be in the cards. So let's start with some basics with the current state of your company in terms of how you go about doing that critical assessment. Starting with strengths and weaknesses. This is your SWOT analysis, strengths, weaknesses, opportunities, and threats analysis. One of the biggest mistakes I come across in a multi-generational business is handing the reins over to junior and finding out that there were some issues in the business unaware of by the successor generation that they just couldn't fix. Doing a SWOT analysis and making it visible to your management team and to your successors in particular will solve that problem. Secondly, don't assume that the future is going to be a continuation of the past. Businesses change dramatically, as does the business environment over time, and you've got to take that into consideration. Next, explore different scenarios of how your business is progressing and understand that trends are occurring in your industry. I'm sure you're well aware of that, but you need to be thinking about those trends and what potential variants might come to bear over the next 5 to 10 years. Next, and very importantly, involve others, key management, your advisors, your advisory team, your successors, to avoid blind spots and some more traditional approaches. Quite honestly, you don't need to tell them why you're doing this assessment. After all, it's really business management 101 stuff, but the fact that they're being involved and included will help a lot in terms of the transition that will occur. Some of the key components of your analysis, and I'm going to go through these very quickly. From a product standpoint, you want to look at your product development capabilities, your current product line, your manufacturer and supplier relationships. You want to compare your costs with industry. You want to look at your market share, both current and its potential, and your sales growth, whether or not it's increasing or slowing down. What are the industry trends? What are some assumptions you can make about the future in terms of your market share? You want to look at your distribution channels, pricing strategy within your marketing, your key customers, whether or not your business is dependent on certain key accounts, the motivation of your sales force, how good your customer service systems in place are, whether or not your customer service is supported by your corporate culture, competition as to whether or not they're getting ahead of you in a particular area, such as e-commerce, whether or not you're able to change or lower your prices, whether or not your competition is able to do that, whether or not global or non-traditional forces are coming to bear. Leadership, what does your management team look like? Are they all over the age of 50? Are they a blend of younger and older folks? Are they homegrown? Are they experienced outsiders? How are decisions made? And your resources. For example, what is the biggest bet that you can afford to lose on a new idea? Is your capital base sufficient to grow and take risks? Have you outgrown your banking relationships? Do you innovate on a regular basis? Drilling down into some specific items that we just discussed, I wanted to point out some key concepts that are critical to address if you want to keep your business. And I'm going to go through these really fast, and there's no need for you to write all of this down because I'm sure that we'll make sure that you have a copy of this list at the end of the webinar. But first of all, patient capital. This goes back to the comment I made earlier about the balance between shareholder motives and the business. Can shareholders wait if it's better for the business to apply capital within the business versus extracting it? That would relate to capital needs for growth initiatives, evaluating whether there are sources to increase the company's capital, and making sure that the shareholders are patient concerning their liquidity. Risk management. Does your shareholders' return correlate with the risk? Do you consciously seek to take measured risks to stimulate the business? External forces, how are they having an impact on you? The future owners and managers assess industry forces, and have you considered and agreed upon what it will take to meet those challenges? You have management of internal resources. Is management challenged to take the risks? Are they involved to help solve problems? Is leadership cultivated consistently? And is there a board actively involved in your succession process? What is the cohesiveness of the current owner structure? Do they collaborate on finding solutions to problems, work as a team? Senior generation assists successors in learning how to partner? Does your compensation structure pay different salaries to owners based on responsibility and performance? And wealth consolidation within your family. Are there entities formed and functioning to hold the family assets? What does your estate plan look like? And were the adult members of the next generation involved in the decisions about those entities? That's very important, by the way. Decision making. How did that happen? Are major decisions limited to one or two people at the top of the company, or is it pushed down into the organization? Are there specific limits of authority given to others, and is accountability by others encouraged? And lastly, with respect to liquidity, is there a way to provide liquidity to shareholders who wish to sell a few but not all of their shares? Is there regular reporting on the value of the business, and is business performance compared regularly to other peer companies? So let's move on to the financial assessment you're going to want to undertake. Let me say that one of the ideas you want to have in your head is my business sellable? If I didn't own it, in other words, would I want to buy it? And if so, for how much? Simply put, well-performing businesses are sellable, and even if you plan to keep it, your personal benefits and your family's benefits and dividends are going to be determined by how your business is performing. And the best way to do that is ask yourself that question: would I buy my own business? The baseline number that you want to know is how much is your business worth? Has it been independently valued, in other words? Quite honestly, guys, you cannot rely on a number that a competitor called and offered you a year ago in confidence. You certainly can't rely on industry averages for this type of assessment. Your company is unique, and it needs to be evaluated more comprehensively than those approaches are in order to assess its true value. One of the issues that I run across frequently is whether or not your financial statements have been compiled or reviewed or even audited by an outside accountant. That's going to be very important, not only to you, but to your family, and in the event that you're selling your business, it's going to become very critical. Next, you want to know what your business could be worth. Not only what it's worth today, but what could it be worth in 5 to 10 years if you made some improvements. Once again, would a buyer want it? Is it attractive for sale? What is the market saying about a business like yours, and is it worth a high multiple or a low multiple? Is the business your personal checking account? And what are you doing to minimize taxes? Those are a couple of areas that are less specific as it relates to the books today, but you need to be consulting with your tax advisor about minimizing taxes both personally and corporately, and making sure that if you're in the position to sell your business, that you're taking measures to ensure that the business is no longer your personal checking account. I thought it'd be helpful to share numerically the financial comparison of keeping versus selling. And once again, these examples are very simplified for today's discussion, but I think that they illustrate the need to understand the complexity of evaluating your keep or sell decision. So let's make some basic assumptions here. Let's say you have a business, sales price is $2 million, all cash. You don't have any basis in the business. You start at from scratch. Say that there's a federal and state capital gain tax of 20%. And once you sell this business, your goal is to withdraw $150,000 a year, and let's say that you are 54 years old. So what does that look like? Well, obviously it depends on the rate of return that you assume you obtain with the assistance of your investment advisor on the net proceeds from selling your business. I put together a table here showing 4 different rates of return: 8%, 10%, 12%, 15%. I know that's pretty optimistic in my view. But what does it look like in terms of withdrawing that $150,000 a year? How long would your account balance last? And what would it look like over 15 years in particular under those various rate assumptions? So I'm going to take 8% at the top line there. After 15 years, you still have a little bit of money left, $87,000, but basically your proceeds are going to last for about 15 years, and then at age 69 they will be exhausted. That may or may not mesh into what your plans are, and if they aren't, then you would need to be achieving a higher rate of return on your assets in order to get them to last longer. For example, at 12%, you have a very decent account balance at the end of 15 years, and the proceeds are lasting through age 83, which is a little bit more realistic scenario. Now let's look at if you wanted to keep your business. What would that look like? Once again, you have a business worth $2 million after your compensation, and you still withdraw that same $150,000 annually as compensation. So if you found a way to evolve your role into one that's less involved with the day-to-day operations, for example, you develop a senior executive or even a successor generation, hire someone, etc., and you continue to draw a salary that's comparable to the investment distributions from my earlier example, you can begin to see the legacy potential for your family in keeping the business. So once again, same business, same assumed rates of return, but now those rates of return are what are being generated within your business and what the value of the business grows to over 10, 20, and 30 years at those rates. And even at 8%, after 30 years, at your age 84, the business value has grown to $20 million. That's the tug for wanting to keep the business within the family, and also why I mentioned earlier business owners are finding ways to stay within the business, modify their roles, continue to extract value, and then plan to sell or transition the business down the road when it has grown to a much more significant number. And lastly, and probably the most important, I'll wrap up by covering the personal side of your decision-making process. It's often overlooked, but failing to do some soul-searching often means that you neglect some of the most powerful reasons to either keep or sell your business. Starting with how ready are you emotionally to prepare for a transition? I had a business owner who had a business that he had grown over about 35 years, had decided selling was the right choice for him, sold to a competitor from another town, didn't think much about it until the day that about 6 months after closing that he drove by his old business, and the sign, the company which had his name in it had been replaced with someone else's, and it really put him into a funk. He was very depressed after that and really regretted his decision. And so those are the sort of things that you really want to think about and involve your family in terms of thinking about that next phase in your life if you are planning on selling your business or any other kind of transition for that matter. How ready are you financially? what do you need and for how long? As we looked at in that example a little bit ago, business worth $2 million sounds like a lot of money, but once you look at what that money can produce over a normal retirement period, it may or may not be enough. And I'll just point out that in a recent survey completed last year, 75% of business owners profoundly regretted their decision to sell within 1 year of exiting due to a lack of readiness. Keeps coming back to that same mantra of plan, plan, plan. And this is one key element of that. Having a vision for the future is critical in the planning because it's going to articulate your philosophy, but it's also going to give your employees and your family the direction that it needs to take. So in that regard, it's a compass that allows strategic change while maintaining your core values. And without that, succeeding generations may not be able to navigate conflicts and crises. And lastly, the personal gut check. Here are some personal signals that you need to be aware of, and I see these a lot, and they can most definitely impact your decision to sell or keep your business. Have you developed an aversion to risk? If you have, you may not want to be thinking about continuing in your business, at least in your current role. Businesses today need to take risks in order to maintain the status quo, let alone grow and achieve more. Would others say that you're becoming more and more inflexible? Or your decision making becomes somewhat myopic or narrow? Have you developed a narrow perspective, and do you avoid new ideas presented to you? Once again, businesses and the business environment is changing. It's going to need to evolve over time. You might have some waning interest. And in fact, as mentioned earlier, there may be some reduced family pressure in terms of successional planning or multi-generational businesses. If that pressure is gone, selling might be the right option. There might be a strategic decision involved, including the consolidating industries, and once again, reduced capital gains taxes. They are historically low. And as Bill mentioned at the beginning of our conversation, the window of opportunity to sell a business could actually begin to close. And because of the supply and demand issue, more and more businesses are coming out of the market that will continue to escalate over the next 5 to 10 years. There may be a point where it is the best time to sell, and after that it becomes much more difficult to do so for the particular business. So with that, I'm going to turn it back to Bill to recap, and then we can dig into some of your questions and then close this out for today. And I'll just point out that if you didn't type a question in today, feel free to email Bill. We can certainly field your answers to your questions offline, and maybe in a more comprehensive way than we could today. We are here to act as a resource to you, so please feel free to reach out if you need to do that. Bill?
All right, thanks, Cliff. I appreciate it. Great job there. A lot of information. I'm going to go over a quick brief recap before we get into questions here on what we just talked about. First thing is the fundamental question that every business owner must ask and be prepared to answer: should I keep or sell my business? I'm hoping and I'm very confident that Cliff gave you certain questions you need to ask yourself and paths you can follow to get to that answer. That was our goal today, and I'm pretty comfortable that he did a great job of explaining that. Next up, being able to adequately answer that question requires two things. Number one, is your business structured to support the vision? Are you ready to sell? Are you ready to hand it on? Are you ready to keep it and take the money out in a separate way? That's questions that have to be asked by you. Then the various parties, an owner, employee, family, are they all able to support the decision? Are they on board with you being, if your wife, you've been working 30 years, 16 hours a day, is she going to want you around the house, for us, every day? That might be a decision that has to be made by everybody. Okay? Next up, one of those sobering stats we talked about earlier. How many businesses die because of an assumption? Okay? Answer to that clearly is too many. And, that's because there's a reason why there's so many. It's because they do not have a plan in place. Okay? They never think it's going to happen to me. Okay? I'm going to be fine. I'm going to be ready to go. But as you saw today with the numbers we gave you at the beginning of the presentation, and as Cliff talked you through, you see what you have to do. And you may be doing a lot of those things already, which is great, but you also see the things you need to also do in addition to make your business attractive when it comes time to make a move. And the last point here, Most business owners do not have a written strategic plan for their business. Without one, how can you ensure success once you decide to keep or sell? I know everybody's got an idea in their mind. You know, you saw the Powerball was $400 million last night. I had that business plan in my head all night last night, how I'm going to spend that $400 million. Okay? But if you guys are doing it in your head, you don't have it on paper, it doesn't mean a whole lot. So that's one of the first things you have to do is make it official and put it on paper so everybody sees where you're trying to go and how you're going to get there. And that's kind of right there. We're going to wrap up there, and I'm going to head now to go through some questions we have. And again, you still feel free to type questions in if you have any after the presentation, because that old saying, there's no thing as a dumb question. Well, when you're talking about your own business, that's especially true, because you got to ask every question possible so you are as informed as possible to keep your business running. So I'm going to try real quick here to read a first question here. And again, these are anonymous, so if you think it's a dumb question, still send it anyway.
Have any questions on your end come through?
Yeah, I did get. Here's one. Why do I need to have my company valued if I already know what companies in my industry sell for? That's a good question. So my answer to that would be that there's a range for just about every industry, and that range can produce very dramatically different results. For example, if your industry average is a 4 times earnings multiple, the range might be 2 to 6 times earnings. And so a company with $1 million in earnings could be worth anywhere between $2 and $6 million, and it may even be higher or lower depending on unique characteristics of the business. But more importantly, though, is knowing how your company creates value, not just the number, and how can that value be improved over time by addressing the internal workings of your value generators. So a good valuation will do both. It will tell you what the current value of your business is, and it will also tell you what the potential maximum value of your business could be, with some identified areas to improve upon that value gap. And that gets back to the whole question of what do you need this business asset to do for you, and what sort of value does that business asset need to accrue to over time in order to achieve those results. Bill, any questions on your end?
Right now we're trying to shuffle through here, so if you have any more that I accidentally got sent to you, feel free to read those. Go ahead, if you have any.
That's the only one I saw.
Okay. Okay, well, I guess there's no more questions here. I'm going to turn it over to Art right now, but I just want to say thank you to everybody who was there today. I hope you got a lot of information, and I will be following up with you in the next day or so. And we can pursue things a lot further and get a lot more information to get you, your business, and your family on the track to where you want to be. And turn it back to Art. Thank you.
Thanks, Bill. Hey, thank you for listening today. Hope you really enjoyed it. We certainly would like any kind of feedback you would care to give. We would be happy to have that. You can certainly get in touch with myself, Bill, or Cliff. I want to remind you that Part 2 in this series is going to be February 25th, and it is what happens to my business if I'm not here. So hopefully you got a lot of good points out of this, and hope you have a great rest of the day. Thank you very much. Take care, and goodbye.